Hey everybody, Will Gomez here for Perpetual Pip, and it's time for another trading video. Now, unlike the last videos that you've been watching, hopefully you've taken the time to watch our Trading 101 series. If not, be sure to go ahead and reference that playlist or go into, if you're on our website, perpetualpip.com, just go over to the Trading 101 section under the Learn to Trade tab, and you'll be able to view those steps which will walk you through all the necessary information to be able to be effective at recognizing patterns and placing positions. Today, though, we're going to talk about the hot topic of the century, if you will, as far as the financial world is concerned, cryptocurrencies. What is the buzz all about? Let's find out here together. As far as cryptocurrencies are concerned, I'm sure that, as I put right here, if you've got a pulse, at some point you've heard of cryptocurrencies, or you've heard the buzzwords Bitcoin, Ethereum, Litecoin. These are the three major cryptocurrencies that exist. And effectively, cryptocurrencies are exactly what the name indicates. They're a form of digital currency. Now, there are other types of currencies, other types of cryptocurrencies that exist as well. You have Ripple, Zcash, Monero. These are additional currencies, additional cryptos that have come along since the inception of the original functioning digital currency, Bitcoin. These have kind of come into the mix as well. But as far as the big three, these are the ones that traders, especially traders that are thinking about maybe participating with a digital currency, these are the main three that most exchanges are looking at and the ones that most traders want a piece of right now. But these are the top 6 according to most investment sites. So how does this work? First and foremost, as I mentioned, a cryptocurrency is a digital form of currency. The very first working cryptocurrency was created right around January of 2009. And the reason why it was created was in response to the financial crisis that occurred back in 2008. Right? For those of you that may or may not be aware, we initially had it start with the housing bubble bursting, particularly in the United States, right? Banks were getting a little less discerning about who they loaned their funds to, not really caring too much about whether or not these people were able to pay back because due to the fractional reserve process, they didn't really need to keep that much funds on hand, and as a result, they continue to make more and more and insure more and more loans and thus make massive amounts of profit. But at the end, as with all bubbles, it exploded and things went wonky, to say the least. All right, so we had situations where major financial houses were closing their doors and the future of the world's finances were being called into question. People in general were concerned about the future of the system as it stands, right? The current fractional reserve system. So people like a gentleman, or actually right now it's expected, it's considered to be a pseudonym, a fake name, but there was a individual called Satoshi Nakamoto who is effectively being given credit, the most credit for we'll call it the Bitcoin. There are other cryptocurrencies that have come into being since then, but we'll call it the Bitcoin or crypto movement. The person that's been accredited with the most of this of setting this forward is this Satoshi Nakamoto character. So effectively, what he postulated is that as our ancestors moved away from the barter system, right, back in the day when they needed to exchange physical events for, physical objects rather, for goods and services, and governments started to become more and more centralized. In order to kind of keep everybody honest, the government was appointed by de facto as this trusted source, right, to issue the currency and give value, guarantee the value of the currency, right? And so we moved into coins and then eventually into paper money, right? In one way or the other, there were some institutions that were guaranteeing the value by some sort of, like the gold standard, for example, which almost no one follows anymore. Only China, if I'm not mistaken, was one of the main developed nations that does still have an actual weight in a specific commodity assigned to their currency, but that's a discussion for another day. as we shifted into this fractional reserve system, the government was effectively the trusted party, the neutral trusted party, to handle exchanges between individuals. They guaranteed the value of the currency, right? Now, what Nakamoto postulated was that this is kind of open to corruption, though, as we saw with the financial collapse of 2008. So he decided that why don't we move away from this centralized ledger, if you will, because that's all money is. It's a system of regulating or monitoring transactions, right? So why don't we move away from this central ledger and move to something that is decentralized? That was the invention of the digital currency. By assigning the duty of keeping track of the transactions and validating the authenticity of the currency, we create it in a digital environment that is free from human corruption. Okay? So that was the development of the cryptocurrency vis-a-vis Bitcoin. And so for scalability, right, there's only a limited amount of currency in any particular central bank. For example, the Federal Reserve for the United States prints a certain amount of dollars. If they continue to print, that's where the devaluation of a currency comes into play. It's no longer worth as much as it was because of inflation, right? If they print too much, it loses its value. It's only worth something when it is rare, right? Think diamonds, for example. They're only worth anything because they are rare and difficult to achieve. Russia has one of the largest reserves of diamonds, and they only let out a little at a time to, one could argue, artificially prop up the value of this quote unquote precious stone, which is what it is, right? But it's valuable because it's rare. So that same principle has been incorporated into these cryptocurrencies. When it comes to Bitcoin, there's only a certain amount. There's 21 million that should be made available by, if I'm not mistaken, 2040. But in order to ensure the scalability, each coin on its own can be divided into 100 million pieces on its own. All right? But again, that's super specific. Let's just get a general rundown of how it works. When it comes to Bitcoin, again, as we discussed, before this system kind of came into being, whenever we wanted to make exchanges or transfer funds from one party to another, we usually had to go through a central bank, some sort of banking institution. But when we go and we try to make the exchange, because this is being maintained by humans, open to corruption, or even if they're just doing their jobs, it opens up fees, right? So essentially what we put in is not always what we end up getting out of it. So what they did was they came up with this decentralized ledger known as the blockchain. What the blockchain does is it gives the job of maintaining the ledger to computers, digitizes it, and the computers are validating every single Bitcoin or cryptocurrency, whatever cryptocurrency it is that you choose to go after. It validates its transaction history, ensuring that it is authentic. You can view that, but it obscures the individual user's information. Okay? So by doing this, it kind of liberates us from these fees that are associated with central banking. And furthermore, it also opens up possibilities for us to be able to make things happen a lot faster. With this decentralized ledger, the computers are doing all the work. It's being authenticated. The computers take the place of the centralized ledger, and there's less of a % chance of it being attacked, right? Things can happen a lot faster. Now, this naturally, when it comes to security, right, naturally, we are concerned about if anything that has to do with funds, we are concerned with how we're going to be able to protect it. So the individuals that came up with this system were known as cypherpunks, or effectively, they're computer hackers. Right? Computer hackers. They came up with this idea, and naturally, being hackers, they can foresee the way that other hackers or individuals that might try to maliciously go after these currencies would think. So built into the blockchain was not necessarily developed to be this decentralized ledger. It wasn't really built around a currency. It was developed around Privacy and security were the main driving factors of the development of this security protocol. So it splits it up into various pieces which different computers around the world are managing. It's not located in any one central location, and as a result of that, it cannot be easily targeted. When we're talking about a bank with centralized funds, it's very, very easy for someone to break into a bank and then make away with the money. But when you have it separated among various different, number one, it's a digital currency, and number two, it's separated and being maintained globally, there is no main location for the thief to try and take the information. If you don't know much about cryptography, I would recommend taking a look into it. But when we're talking about, let's just say, if you're working with a suitcase, let's say that you have your own personal suitcase, that only has 3 numbers that you can select from on a suitcase lock, a very simple device. 3 numbers, and the amount of codes that you can make out of that is fantastic. So imagine when you start to incorporate not only letters but numbers into a computer program, it becomes nigh unhackable. Right? I won't bore you with the details on that, but it becomes nigh unhackable. And as a result, this is a very, very secure method of saving currency or keeping currency in this. All right. Now, we won't ignore the facts. There recently was a very aggressive hack that did occur. Right. It's not impossible. It is very, very difficult. Right. It's nigh impossible. So recently in Korea, you may have heard about this. In Korea, there was a hack where hackers were able to make away with a very large amount of a cryptocurrency. However, it's the same thing. It's very similar to someone robbing a bank. It does not affect the system as a whole. It is simply a very, very small transaction, very small pond in the ocean of crypto that exists. So with that said, let's talk about fact versus fiction, things that you may want to consider before looking to jump in with both feet into crypto investing. You may feel more comfortable with real estate portfolios or actual tangible currencies like the Forex market, my personal favorite. You may be looking into commodities like gold or oil, etc., stocks, options, what have you. These are just facts for you to consider, fact versus fiction, when it comes to cryptos, things for you to consider. So one of the concerns that came into being with respect to cryptocurrencies was that the anonymity, right, that you can track, or for every coin that exists, you can see its transaction history, where it's been, and so that ensures that it is an authentic coin, that you're not getting any counterfeits, which is a lot easier to do when it comes to paper funds. But in any case, you can see the transaction history, but it obscures completely who the owner of the coin is. Right? That's the natural protocol that's been built into this blockchain protocol. So when it comes to the anonymity offered by a cryptocurrency, critics of the cryptocurrency said, well, this anonymity opens it up for criminals to be able to use it for all kinds of nefarious purposes. And then shortly after that, we had websites like the Silk Road that came up, where people were actually able to buy all kinds of contraband, drugs, guns, you name it, shipped right to their door. Okay, this definitely did not help the reputation of cryptocurrencies. But these things have been shut down since then, and the reality is that the anonymity that's offered by crypto isn't any different than cash, right? Criminals have been conducting their operations with cash for, since money has been invented. So it's not really anything new. No one knows where the money came from, right? It doesn't have their name stamped on it. And so it's pretty much the exact same thing. In the early days, transfer of coins from one user to the other did take anywhere between several days to over a week, right? And the reason why this slow processing took place was because the main exchange, the only exchange really that existed in the early days for Bitcoin, was located in Tokyo. That exchange was Mt. Gox, was the name of the exchange. Since then, though, and this is probably why you're looking into it right now, interest has kind of skyrocketed. And we have had the development of additional cryptocurrencies as well as the development of the exchange. So we're pretty much looking at virtually instant transfers nowadays, just like any of the other exchanges, just like Forex, just like stocks, options, what have you. The transfers are now taking place instantly. So that is something else that you don't really have to worry about. Last but not least, well, it's a different exchange. It's going to require a whole new skill set. How could I possibly learn to trade this now when I just started learning to trade something else? The reality is, guys, that no matter what kind of exchange you're looking at, if it involves technical analysis and you're looking at it on a chart using candles, right, which in most cases you are 90% of the time. It's just how traders take a look at things with charts, looking at candles, then the technical analysis process is exactly the same. A chart is a chart is a chart. Now, there will be people out there that will try to lead you to believe that it's different because they're trying to sell you something, most likely, but the reality is the technical analysis procedure is the same. If you've unfortunately fallen into that trap and you compared the so-called educations that are being offered on this, you'll notice that apples to apples, it's the same thing. Okay, so if you want to learn more about this, again, it's as far as the technical procedures, how to be able to look at a chart, be able to effectively trade it, that's all available on my website, perpetualpip.com, absolutely free. Take a look at it at your leisure. All you have to do is create a user account, which is also completely free. Go into the Learn to Trade option, and you'll be able to access all the video content in the Trading 101, as well as this video and any additional videos that I put up on cryptos, which I will be looking to do that next. Next video that we're going to be talking about is how to open or create a wallet. You want to be, it's not the same as far as when you create an account, right? With the Forex or with any of the other exchanges, you usually will have to create some sort of broker account, right? With the crypto markets, you can do the same thing, but I would like to encourage caution when it comes to cryptos. Cryptos are incredibly volatile, which is fantastic for opportunity. Opportunity is presenting itself all the time, but you want to be really, really careful trading on leverage with cryptos, okay? Be really, really careful with that. We'll talk more about that next time. If you're watching this on YouTube, be sure to like and subscribe. All the content is also available on YouTube, but I'd be more than happy to work with you on my website. You can email me directly, will@perpetualpip.com, perpetualpip@gmail.com. And when you're ready, or when you feel like you want to trade live, come join us in the live sessions. I perform live analysis on a daily basis. We look for opportunity aggressively, everything from positions all the way down to scalps. Look forward to seeing you there. This has been Will Gomez, FX Showtime. Take care.